Can you score 75% on this 50-question review covering key real estate principles, finance, valuation, and math? Let's find out. And keep an eye on the bottom corner. There's something there that could make a big difference in your prep. We'll tell you how to use it in just a minute. Now, let's get started.
Let's jump right into real estate principles and practices. Types of real estate ownership: fee simple, leasehold, joint tenancy, tenancy in common. Which type of real estate ownership allows multiple owners to hold equal shares and includes the right of survivorship? Is it A, fee simple, B, leasehold, C, joint tenancy, or D, tenancy in common? The answer is C, joint tenancy. Joint tenancy allows multiple owners to have equal shares and includes the right of survivorship, meaning if one owner dies, their share automatically passes to the remaining owners. What is the primary difference between joint tenancy and tenancy in common? Is it A, right of survivorship, B, equal ownership shares, C, duration of ownership, or D, ability to sell interest? The answer is A, right of survivorship. The primary difference is the right of survivorship. Joint tenancy includes this right, meaning ownership passes to other owners upon death, whereas tenancy in common does not.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsey.ai for immediate help and a free study session with Birdsey, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
In a leasehold estate, what is the tenant's right? Is it A, ownership of the property, B, right of survivorship, C, permanent residency, or D, use and occupancy? The answer is D, use and occupancy. A leasehold estate provides the tenant with the right to use and occupy the property for a specified period as per the lease agreement without ownership rights. Legal descriptions and land measurements, meets and bounds, lot and block, rectangular survey. What is the primary purpose of using the meets and bounds system in real estate? Is it A, to determine property taxes, B, to establish zoning regulations, C, to define property boundaries, or D, to calculate building height restrictions? The answer is C, to define property boundaries. The meets and bounds system is used to describe the boundaries of a parcel of land using physical features, distances, and angles. It's often used for irregularly shaped properties. Which of the following is a key characteristic of the rectangular survey system? Is it A, use of principal meridians and baselines, B, reliance on natural landmarks, C, subdivision into lots and blocks, or D, measurement in chains and links? The answer is A, use of principal meridians and baselines. The rectangular survey system, also known as the public land survey system, divides land into a series of rectangular parcels using principal meridians and baselines. In the lot and block system, what is typically used to reference a property? Is it A, natural landmarks, B, recorded plat maps, C, principal meridians, or D, surveyor's field notes? The answer is B, recorded plat maps. The lot and block system uses a recorded plat map, which divides a tract of land into individual lots and blocks for easy identification and reference.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsey.
Forms of real estate contracts, purchase agreements, option contracts, lease agreements. What is the primary purpose of a purchase agreement in real estate transactions? Is it A, to lease a property temporarily, B, to outline terms and conditions of a sale, C. To provide an option to purchase at a later date. Or D. To transfer property ownership immediately. The answer is B. To outline terms and conditions of a sale. A purchase agreement outlines the terms and conditions of a real estate sale, ensuring both buyer and seller understand their obligations. It serves as a legally binding contract once signed. In an option contract, what is the optionee's primary right? Is it A. Right to purchase the property, B. Obligation to sell the property, C. Right to lease the property, or D. Obligation to purchase the property? The answer is A. Right to purchase the property. The optionee in an option contract has the right, but not the obligation, to purchase the property at a predetermined price within a specified time frame. Which of the following is a characteristic of a lease agreement? Is it A. It transfers property ownership, B. It provides an option to purchase, C. It specifies terms for property use, or D. It is used only in commercial transactions? The answer is C. It specifies terms for property use. A lease agreement is a contract that allows a tenant to use a property for a specified period in exchange for rent, detailing rights and obligations of both parties. What distinguishes a purchase agreement from an option contract? Is it A. A purchase agreement is non-binding, B. An option contract transfers ownership immediately, C. Both are used for leasing purposes, or D. A purchase agreement is binding while an option contract is not? The answer is D. A purchase agreement is binding while an option contract is not. A purchase agreement is a binding contract to buy property, while an option contract gives the buyer the right but not the obligation to purchase within a specified period. Why might a buyer choose an option contract over a purchase agreement? Is it A. To immediately own the property, B. To secure purchase rights without obligation, C. To avoid any contractual commitments, or D. To lease the property before buying? The answer is B. To secure purchase rights without obligation. Buyers choose option contracts to secure the right to buy property at a set price, allowing time to decide without immediate obligation or financial commitment. Let's continue with real estate agency and ethics. Types of agency: single, dual, transactional, designated. What is a key characteristic of a single agency relationship in real estate? Is it A. The agent represents only one party in a transaction, B. The agent represents both the buyer and the seller, C. The agent acts as a neutral facilitator, or D. The agent is designated to represent a specific client? The answer is A. The agent represents only one party in a transaction. In a single agency, the real estate agent represents only one party, either the buyer or the seller, but not both in the same transaction. In a dual agency, what is a potential conflict that may arise? Is it A. The agent can advocate strongly for both parties, B. The agent is assigned to only one client, C. The agent acts as a neutral facilitator, or D. The agent may face conflicts of interest? The answer is D. The agent may face conflicts of interest. Dual agency involves representing both the buyer and the seller, which can lead to conflicts of interest as the agent must remain neutral and cannot advocate fully for either party. What differentiates a designated agency from a dual agency? Is it A. One agent represents both parties, B. The agent acts as a neutral facilitator, C. Different agents represent the buyer and seller, or D. The agent represents only one party? The answer is C. Different agents represent the buyer and seller. In designated agency, different agents within the same brokerage are assigned to represent the buyer and seller separately, preventing conflicts of interest inherent in dual agency. How does transactional agency differ from other types of agency? Is it A, the agent represents the buyer only? B, the agent acts as a neutral facilitator? C, the agent represents both parties? Or D, the agent is designated to a specific client? The answer is B, the agent acts as a neutral facilitator. Transactional agency involves an agent acting as a facilitator without representing either party, focusing on assisting with the transaction rather than advocacy. Fiduciary duties and responsibilities. Which of the following best describes the fiduciary duty of loyalty that a real estate agent owes to their client? Is it A, ensuring all transactions are legal and valid? B, prioritizing the client's interests above the agent's own interests? C, providing accurate accounting of all financial transactions? Or D, disclosing all material facts to the client? The answer is B, prioritizing the client's interests above the agent's own interests. The duty of loyalty requires the agent to act in the best interest of the client, prioritizing the client's needs above the agent's own interests or profits. What is the primary obligation of an agent under the fiduciary duty of disclosure? Is it A, to secure the best possible price for the client? B, to keep all client information confidential? C, to disclose all material facts that could impact the client's decisions? Or D, to manage the client's property effectively? The answer is C, to disclose all material facts that could impact the client's decisions. The duty of disclosure mandates that the agent must reveal all pertinent information that could affect the client's decision-making process in a transaction. Which fiduciary duty requires a real estate agent to maintain accurate records of all financial transactions related to the client? Is it A, accounting, B, care, C, loyalty, or D, confidentiality? The answer is A, accounting. The duty of accounting obligates an agent to keep precise and detailed records of all financial dealings and transactions on behalf of the client. In the context of fiduciary duties, what does the duty of confidentiality entail for a real estate agent? Is it A, disclosing all material facts to the client? B, maximizing the client's financial gains? C, maintaining accurate financial records? Or D, protecting the client's personal and sensitive information? The answer is D, protecting the client's personal and sensitive information. The duty of confidentiality requires an agent to protect and not disclose any personal or sensitive information about the client unless authorized by the client.
Stuck on a question? Just think of the Birdsey link in the description as your friendly neighborhood superhero swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Ethical considerations and fair housing laws. Which of the following is a violation of the Fair Housing Act when advertising a property? Is it A, pet-friendly environment? B, no children allowed? C, close to public transport? Or D, quiet neighborhood? The answer is B, no children allowed. The Fair Housing Act prohibits discrimination in advertising based on race, color, religion, sex, handicap, familial status, or national origin. Stating no children discriminates based on familial status. What is the primary purpose of the Fair Housing Act? Is it A, to prevent discrimination in housing-related activities? B, to regulate property taxes? C, to manage zoning laws? Or D, to control rent prices? The answer is A, to prevent discrimination in housing-related activities. The Fair Housing Act aims to eliminate discrimination in housing-related activities, ensuring equal opportunity for all individuals regardless of protected characteristics. If a real estate agent refuses to show properties in certain neighborhoods based on the buyer's race, this is an example of what? Is it A, redlining, B, blockbusting, C, steering, or D, flipping? The answer is C, steering. Refusing to show properties based on race is steering, a discriminatory practice prohibited under the Fair Housing Act. Let's continue with some questions on real estate finance. Mortgage types and loan products, conventional FHA v. USDA. Which type of mortgage is specifically designed for rural property buyers and offers zero down payment options? Is it A, conventional loan, B, Federal Housing Administration, FHA loan, C, U.S. Department of Agriculture, USDA loan, or D, U.S. Department of Veterans Affairs, VA loan? The answer is C, U.S. Department of Agriculture, USDA loan. USDA loans are targeted at rural property buyers, offering benefits like zero down payment and reduced mortgage insurance costs, making them ideal for eligible low to moderate income buyers. What is a key requirement for a borrower to qualify for a VA loan? Is it A, must be a veteran or active duty service member, B, must purchase a property in a rural area, C, must have a 20% down payment, or D, must have a minimum credit score of 720? The answer is A, must be a veteran or active duty service member. VA loans are available to veterans, active duty service members, and certain members of the National Guard and Reserves, offering benefits like zero down payment and no private mortgage insurance. What distinguishes an FHA loan from a conventional loan? Is it A, FHA loans require a higher credit score, B, FHA loans are government-backed, conventional loans are not, C, FHA loans have higher down payment requirements, or D, FHA loans are only available for rural properties? The answer is B, FHA loans are government-backed, conventional loans are not. FHA loans are insured by the Federal Housing Administration, allowing for lower credit scores and down payments compared to conventional loans, which are not government-backed. Which loan type is typically best for a first-time homebuyer with a low down payment and credit score? Is it A, conventional loan, B, Federal Housing Administration, FHA loan, C, U.S. Department of Veterans Affairs, VA loan, or D, U.S. Department of Agriculture, USDA loan? The answer is B, Federal Housing Administration, FHA loan. FHA loans are ideal for first-time homebuyers with low down payments and credit scores due to their flexible requirements and government backing. Loan-to-value ratios and mortgage qualification standards. What is the primary purpose of the loan-to-value ratio in real estate finance? Is it A, to calculate the interest rate of a mortgage, B, to determine the annual property tax, C, to evaluate the risk level of a mortgage, or D, to set the monthly mortgage payment? The answer is C, to evaluate the risk level of a mortgage. The LTV ratio is used to assess the risk level of a mortgage by comparing the loan amount to the property's value. A lower LTV indicates less risk to the lender. How does a higher LTV ratio impact a borrower's mortgage qualification? Is it A, it reduces the need for private mortgage insurance, B, it may require the borrower to pay for private mortgage insurance, C, it guarantees lower interest rates, or D, it eliminates the need for a down payment? The answer is B, it may require the borrower to pay for private mortgage insurance. A higher LTV ratio indicates a higher risk for lenders, often requiring borrowers to pay for private mortgage insurance or face stricter qualification standards. What is a typical maximum LTV ratio for conventional loans without requiring private mortgage insurance? Is it A, 80%, B, 90%, C, 70%, or D, 95%? The answer is A, 80%. For conventional loans, the maximum LTV ratio without requiring PMI is typically 80%. This means the borrower must make a 20% down payment.
Notice the code in the corner? When you're stumped by a question, enter it at birdsey.ai for immediate help. Enjoy complimentary study sessions and access to hundreds of additional questions to help you pass your exam with confidence.
Truth in Lending Act and RESPA regulations. Which of the following disclosures is required under the Truth in Lending Act for a real estate transaction? Is it A, loan-to-value ratio, B, annual percentage rate, C, property tax assessment, or D, deed of trust? The answer is B, annual percentage rate. TILA requires lenders to provide borrowers with the annual percentage rate disclosure, which includes the cost of credit expressed as a yearly interest rate. Under RESPA, which document must be provided to borrowers within 3 business days of a loan application? Is it A, closing disclosure, B, homeowner's insurance policy, C, loan estimate, or D, title insurance commitment? The answer is C, loan estimate. RESPA requires lenders to provide a loan estimate form within 3 business days, detailing the estimated costs and terms of the mortgage loan. What is the primary purpose of the RESPA regulations in real estate transactions? Is it A, to ensure transparency in real estate transaction costs, B, to regulate real estate agent commissions, C, to establish interest rate limits for mortgages, or D, to mandate homeowners insurance requirements? The answer is A, to ensure transparency in real estate transaction costs. RESPA aims to protect consumers by ensuring transparency in the costs associated with real estate transactions, preventing abusive practices, and eliminating kickbacks. Now let's review real estate valuation and appraisal. Sales comparison, cost, and income approaches to value. Which approach to real estate valuation primarily uses comparable sales data to determine the value of a property? Is it A, sales comparison approach, B, cost approach, C, income approach, or D, market approach? The answer is A, sales comparison approach. The sales comparison approach relies on analyzing recent sales of similar properties to estimate the value of the subject property. It is most effective in active markets with sufficient comparable data. In the cost approach, which of the following is not typically considered when estimating the replacement cost of a building? Is it A, depreciation, B, construction costs, C, comparable sales, or D, land value? The answer is C, comparable sales. The cost approach focuses on the cost to replace or reproduce the building, accounting for depreciation. Land value is separate, and comparable sales are not directly used in this approach. When using the income approach, what is the capitalization rate primarily used for? Is it A, estimating replacement cost, B, converting income into value, C, adjusting for market trends, or D, assessing property depreciation? The answer is B, converting income into value. The capitalization rate is used to convert the property's income into an estimate of its value. It reflects the expected rate of return and risk associated with the investment. Let's test your understanding of real estate transactions and closing procedures. Title insurance, deeds, and transfer of title. What is the primary purpose of title insurance in real estate transactions? Is it A, to ensure the physical structure of the property, B, to facilitate the transfer of ownership, C, to protect against financial loss from title defects, or D, to guarantee the property's market value? The answer is C, to protect against financial loss from title defects. Title insurance protects property buyers and lenders from financial loss due to defects in a property's title. It ensures that the buyer receives clear ownership and covers legal fees if a dispute arises. Which type of deed provides the most comprehensive warranty to the grantee? Is it A, general warranty deed, B, quitclaim deed, C, special warranty deed, or D, bargain and sale deed? The answer is A, general warranty deed. A general warranty deed offers the most protection, guaranteeing the title is free from any defects, even those prior to the grantor's ownership. It covers the entire history of the property title. In the context of real estate, what is a deed? Is it A, a contract for property sale, B, a legal document transferring property ownership, C, a financial agreement for property purchase, or D, a record of property tax payments? The answer is B, a legal document transferring property ownership. A deed is a legal document that transfers ownership of property from one party to another. It must be executed according to legal standards to be valid, including being signed and delivered. Escrow, closing disclosure, and settlement procedures. What is the primary purpose of an escrow account in real estate transactions? Is it A, to hold funds until transaction conditions are met, B, to calculate property taxes, C, to determine property value, or D, to manage real estate listings? The answer is A, to hold funds until transaction conditions are met. An escrow account is used to hold funds safely until all conditions of a real estate transaction are met. It ensures that both parties fulfill their obligations before money changes hands. Which document provides a detailed account of all costs associated with a real estate closing? Is it A, purchase agreement, B, closing disclosure, C, escrow instructions, or D, title insurance policy? The answer is B, closing disclosure. The closing disclosure form itemizes all costs associated with a real estate transaction, ensuring transparency and understanding of the financial details for both buyers and sellers. What is the role of a settlement agent during the closing process? Is it A, appraise the property, B, negotiate sale terms, C, coordinate document signing and funds transfer, or D, inspect the property? The answer is C, coordinate document signing and funds transfer. A settlement agent facilitates the closing process by coordinating document signing, funds transfer, and ensuring all transaction conditions are met. They play a crucial role in finalizing the sale. Which of the following is typically not included in the closing disclosure? Is it A, loan terms and conditions, B, itemized closing costs, C, transaction fees, or D, personal financial advice? The answer is D, personal financial advice. The closing disclosure includes details about loan terms, closing costs, and transaction fees. It does not typically include personal financial advice, which should be sought from financial advisors. Let's continue with real estate math and calculations. Commission and net profit calculations. A real estate agent sells a property for $500,000 with a commission rate of 6%. How much commission does the agent earn? Is it A, $25,000, B, $30,000, C, $35,000, or D, $40,000? The answer is B, $30,000. The commission is calculated by multiplying the sale price by the commission rate. For a $500,000 sale at 6%, the commission is $500,000 multiplied by 0.06, which equals $30,000. An agent receives a total commission of $24,000 for selling a property at a 4% commission rate. What was the sale price of the property? Is it A, $600,000, B, $480,000, C, $720,000, or D, $800,000? The answer is A, $600,000. To find the sale price, divide the commission by the rate. $24,000 divided by 0.04 equals $600,000. This is the correct sale price for the given commission. A property sold for $300,000 and the agent earned a commission of $18,000. What was the commission rate? Is it A, 4%, B, 5%, C, 6%, or D, 7%? The answer is C, 6%. The commission rate is found by dividing the commission by the sale price. $18,000 divided by $300,000 equals 0.06 or 6%. If a seller wants to net $200,000 after a 5% commission, what must the sale price be? Is it A, $190,000, B, $200,000, C, $205,263, or D, $210,526? The answer is D, $210,526. To find the sale price, divide the net amount by 1 minus the commission rate. $200,000 divided by 0.95 equals $210,526.32, which rounds to $210,526. Property tax prorations and mortgage interest calculations. A property has an annual tax bill of $3,600. If the property is sold and the closing date is June 30th, what is the prorated tax amount owed by the seller, assuming the buyer is responsible for taxes starting on the closing date? Is it A, $1,500, B, $1,800, C, $2,400, or D, $3,000? The answer is B, $1,800. The seller is responsible for taxes from January 1st to June 30th, which is 6 months. Therefore, the prorated amount owed by the seller is $3,600 divided by 12 multiplied by 6, which equals $1,800. A homeowner has a mortgage with an annual interest rate of 4.5% on a principal of $200,000. What is the monthly interest payment? Is it A, $75, B, $700, C, $750, or D, $800? The answer is C, $750. To find the monthly interest, multiply the annual interest rate by the principal, then divide by 12. $200,000 multiplied by 4.5%, then divided by 12, equals $750. If a property's assessed value is $250,000 and the tax rate is 1.2%, what is the annual property tax? Is it A, $3,000, B, $3,200, C, $3,500, or D, $2,800? The answer is A, $3,000. The annual property tax is calculated by multiplying the assessed value by the tax rate. $250,000 multiplied by 1.2% equals $3,000. A buyer takes out a mortgage of $150,000 with an interest rate of 5% per annum. How much interest will they pay in the first month? Is it A, $500, B, $625, C, $750, or D, $700? The answer is B, $25. To calculate the first month's interest, multiply the annual interest rate by the principal, then divide by 12. $150,000 multiplied by 5%, then divided by 12, equals $625.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit birdsey.ai for complimentary study sessions with Birdsey, your AI-powered study partner.